Let's pick it up with Peter Anderson, Chief Investment Officer at Anderson Capital Management, and Jeff Kilburg, founder and CEO of KKM Financial and a CNBC contributor. Peter, you have a bit of a bone to pick, it seems, with the Fed. What is it and why?
Well, I worry that the Fed might actually still over-tighten. I understand what's happened today and the market reaction. But, there is a delay with when the Fed takes actions and then when we actually see it in the marketplace. And, Tyler, we have started to see receding inflation in many sectors. I mean, let's talk lumber, for instance. Lumber has almost crashed. And as we know, there's no Fed intervention on lumber prices and other commodities, too. So what I am very, very much concerned about is, say, October comes around. Say the Fed has tightened 75, even 100 basis points. What will the Fed say then? And I think what we need to hear from the Fed is just a simple admission that, yes, we are still tightening. However, we do observe and acknowledge that there are signs that this is starting to abate. And if we see enough of that, we will change our policy actions. I think that would work wonders for giving us some kind of roadmap as to what they're actually thinking.
How does that strike you, Jeff Kilburg? Sounds sort of reasonable.
It does, Ty, and I'm cautiously optimistic, but I think the velocity today, that's really bothersome. I don't see panic. Look at the VIX. The VIX isn't even above 26. But what's interesting, and I think Peter's right, it's a comprehensive lens that we need to look through, and that's exactly what the Federal Reserve is looking through. Today, we are bothered by the higher than expected CPI data. But let's just look back at mortgage applications. They're down 25% year over year. We're seeing housing cool. We are seeing used car prices. That was the biggest input, if you remember, Ty, during the pandemic. Everyone was going out buying used cars. That number is abating. It was down 4% in the month of August. So I think there's other ways to look at inflation potentially abating, but the Federal Reserve is not going to do 100 basis points. Yes, I said it. They are not going to do 100 basis points. They have been articulating in the defense of Fed Chairman Powell. He has been articulating they have the ability to be nimble, but they do have a problem. And the problem was a year ago, they were still buying assets. They were just buying assets up until February of 2022. So they need to get the September meeting at 75 basis points in the rearview mirror. Everyone needs to take a deep breath and find some essential, tangible names, some sectors like you talked about with Pippa earlier about utilities, consumer staples. These are very dislocated pricing in a market like today. Go in and buy what you like, buy what you know, buy what you use, Ty.
And so exactly, Jeff, I want to pick up on that point here before we turn back to Peter. What is it that you like? Give us some exact names, if you can, within some of those spaces or otherwise.
Look at Nutrien, look at Archer Daniels, look at Oracle. Not a lot of tech names on a day like today, Courtney, that you want to have a better understanding. But Waste Management, some of these blue chip tangible names, remember Peter Lynch back in the 80s, buy what you know? This is just a step further. This is buy what you use. So I think you have to really embrace this change from growth to value. And I know growth had a little bit of a run back in the last 4 days, but I think you have to have a large cap blend hat on. You have to understand where there is dispersion. And some of the sectors that typically haven't gotten a lot of love, like utilities, like consumer staples, like healthcare, look at XLU, look at XLP. These are names that you have to be repositioned. So this is a great opportunity to rebalance, reposition portfolios, because we are going to get this Fed meeting in the rearview mirror. And then we're going to get some midterm election certainty. And there's going to be a rally coming to Q4, Ty. You heard it here first.
All right, my friend. Let's hope that passes over to your Fighting Irish this weekend. Peter, let me turn to you. You give thumbs up to Caesars, thumbs down to a couple of its subjects, Carvana and Netflix. Why?
Well, Netflix, let's just quickly talk about that. In real estate, they talk about three things: location, location, location. With Netflix, it's three things also. It's programming, programming, programming. And I think we can all agree that Netflix has taken quantity over quality. And do you know they were the ones that made the most movies last year, and yet they have the worst ratings of all their competitors. So I don't even have to go into the balance sheet and income statement with a company like this. I do think that it is destined to really fail unless they totally revamp their programming. And with Carvana, it's the opposite.
Didn't they have Squid Game, and don't they have Ozark?
And they've got The Crown. I think people are watching that all over the place again.
I don't disagree with your point because I don't know that maybe their features have not been good, but their series, they've got some ones that hook you.
Yes,
almost
and
said something else there.
maybe you'd like to watch those over and over again or something. But it is a hit-based business, and
The
just
Kilburgs
like
watch a lot of movies over and over, Peter. We here at the Kilburg family will crush Netflix whenever we get an opportunity.